Okay, and I will be recording this up until the question and answer period. So I will stop recording at that point. We'll be posting this to our various social media feeds for people that can't make it and people that might want to rewatch after the fact. So, but when anyone is asking questions, we will have recording off, just so everyone's informed of that. Okay, so where are we at today? So this kind of gives some context to performance since 1988. Each little blue line on this chart represents a quarter's return. So there's 4 a year. So, do the math. There's about 125 return streams here. Up here in the corner, you can kind of see where we're at. First quarter of 2023, 7.5%. So towards the, kind of higher end, if you will, of positive returns. And contrast this with the second quarter of last year when, inflation was peaking in June and the sky was falling. We had a negative 16.1% return. Two things that you can kind of take out of this is that overall, the stock market does perform in a positive direction. They definitely outnumber the negative quarters. Another thing is that there's just a wide variance in returns from quarter to quarter. We're long-term investors here. So, we look at things at year, 3-year, 5-year, even 10-year types of timeframes. So, 1 quarter, anything can happen. So that just kind of allows us to take a step back and see it kind of the forest for the trees, if you will. So also here is the fourth quarter of 2022. So, 2 quarters after this horrible quarter of negative 16%, we see the market coming back at 7.6%. And had someone stayed invested and not kind of reacted there, they would definitely be generally in a market portfolio, they would be up. So, suffice to say that there's no timing the market. And this one I've shown many times before, but it's just one of my favorite charts, and I really try to kind of think of this every day in terms of not timing the market. Again, not to be repetitive, but I think it's just such a powerful message. This is right after the great financial crisis. 2 different lines. The dark blue is someone that said, you know what, I'm going to take money off the table and just kind of try to time things and wait for a better entry point. And that blue line ends up, this is $100,000, ends up after 10 years, approximately doubling. And another person who said, I just don't know which way things are going to go tomorrow, which way the wind's going to blow. And I'm just going to kind of invest in the mental concept that the market typically in the United States economy and global economy for the most part goes up over time. And that's exactly what we see. And you can see that this ended up tripling up to 300,000, more than double the return of someone that tried to kind of, outsmart the market, if you will. So, and this next chart basically says the same thing, kind of in a different way, and actually more powerfully, rather than just from 2009, this is actually this century. So the last 23 years through March 31st. What this shows is if someone remains fully invested and they started out with $100,000, just invested in the general market, you would have more than 4x multiplier of your money here at 434,000. Now, if you try to guess things and you just missed in all of that time, in 23 years, you missed the 10 best days when that market, for whatever reason, news happenings or global geopolitical events, the best 10 days, you just missed those days out of, whatever, over 800 days. You'd have only had less than half that return, and missing more than that, you can kind of see the story gets very, very, very sad. As if you just missed the best 50 days out of 23 years, you would actually have lost money to the tune of 66% of your money in that time frame. So we aren't market timers here. We'll take opportunist bets when we see that there's a good long-term risk return basis for doing so. But as far as day trading, week trading, even month trading, we definitely try to steer clear. So kind of getting back more to where we are today. This graph, I was talking to Christine, one of our advisors today, about how it's a little bit too wonky and nerdy, just even to explain it, but it is pretty instructive. And what these 2 lines show, each dot along each of these lines, the yellow line shows that at this time period in time in March of 2022, for instance, this is where the Fed predicted that the inflation would be at the end of this year. So this is kind of a snapshot of where they were at, where their thinking was at in time. And the yellow line with the inflation here is really interesting because, at the beginning, the story out of the Fed was that coming out of COVID, inflation was transitory. After the supply chain gets cleared up and everything, this should just simply go away. And at the September 21, we were at 2%, right around the goal, right? Well, they started kind of seeing what was going. This is going to be with us for a little longer, and it was much stickier than what they had initially anticipated. To their credit, they pivoted and changed their policy going forward in reaction to the data. So as it sits now, at the March, just last March, they believe that at the end of this year, inflation will be, call it 3.75%. And conversely, the same type of data examination, this is the orange line is GDP growth, where we think the economy is growing, where the Fed believes it will be growing. So, in December 21, they thought, inflation and GDP growth about the same 2% growth rate. And coming to March of 23, they believe that by the end of this year, GDP growth will be well below average. Average is between 2 and 3%, call it. We're going to be about 0.5%. So although that sounds terrible, that's actually the intended consequence. That's what they want by raising these interest rates, making things a little more painful to do business, to get loans, just basically chilling business activity that will hopefully bring down the GDP growth to a not dire level, but a level that will allow inflation to be reined in, and then the economy to kind of continue without a big retracement backwards. And that's basically what the majority of I think the smart money is thinking, that a small recession is where the odds are that we're going to land, and that's what we believe at Fit as well. So, and here's the inflation path where we're at. Like I said, we were down around 2% around 2020, even through 2021, and then as the economy came back online and all of the stimulus spending was churning around the economy, inflation gradually went up, and like I said before, in middle of 2022, it peaked at just a little bit over 9%. Well, those interest rates, they're working. The Fed, it's an imperfect science, but as you can see in aggregate, things are coming down and in a pretty good pace. We're right under 5% as of the last inflation report. We get one later this week, and hopefully that number will come down some more. As I said, the goal is typically in the long run about 2%, and we're at 5% now. And that prediction on that plot a couple graphs ago was that we'd be at about 3.75% by year's end. So let's hopefully see that trend in the numbers coming out of the inflation report this week. Recession, like I said, most likely a mild case. This is the other chart that I had thought about taking. It's a little wonky, but there's a signal that shows a potential for a recession, and that's an inverted U.S. yield curve. All that means, all that fancy talk means is that the 10-year, what you get for investing your money in the government for 10 years, lending it to the government, the return you get on that is actually less than what you'd give it for 2 years. And that goes against common sense, because if you lend your money out for a longer period of time, you should be compensated, because that's longer risk, more things can go wrong. So at 10 years, you should be getting more of a return. Well, things are kind of turned on their head recently, and you're actually getting more money to keep your fixed income bets at a lower time frame, lower duration is what the technical term is. As you can see, as when this number kind of dipped below zero, you can kind of see that you have a recession. Here's the big one coming out of the great financial crisis when the numbers dipped down, and smaller one in 2020 at the start of COVID. And what I was actually at a conference a couple weeks ago in Chicago for Morningstar, which we use for a lot of our investment research and trading platform. And I was able to, one of the keynote speakers was Larry Summers, former Secretary of the Treasury. And basically coming out of that, he was of the mind that that we were headed towards a very, very mild recession, all things considered, all the things we went through, all the largesse in spending, that earnings are going to come down. Economic activity is going to slow, as intended. And but it looks to me that Summers is right. He's a very smart guy, and that a really bad recession is not in the cards. And Actually, this weekend, my personal hero, Warren Buffett, they had the Berkshire Hathaway annual conference, and it was basically an all-day affair, and it was on MSNBC. So I was kind of glued to my TV watching that, and he basically echoed the same sentiment as Larry Summers, that even in his companies, which range the gamut of the economy, we're talking See's Candy, Duracell batteries, Geico Insurance, Apple, you name it, financial services, Coca-Cola, those earnings will come down a little bit, but overall it's not going to be the sky's falling, and basically that long-term trend is not going to take a big dip, and things should keep chugging along per usual. So it's good to hear two very guys that I personally hold in very high esteem to kind of come out on the same side of that. And what is the point of all that interest rate hiking? Well, it's to cool down the economy. And this graph kind of shows where we're going with that. The orange line is the United States, yellow is Europe. And it basically just shows the general credit conditions where we're at right now. Above this line means tightening, below that means easing. And you can kind of see that that's where we're at. So, loans are harder to get. Everything is more expensive to buy a house, a car, business loan. So that's automatically going to lower returns on those potential investments, and people are going to keep money on the sidelines and save more, and basically essentially cool down the economy. So that's what we're seeing. Tightening always sounds bad, but in this case, it's what the doctor ordered, and it seems to be playing out in real time. And in terms of employment, this last week's employment report was actually greeted kind of neutrally, but slightly positive by the market. It had been expected that unemployment would rise somewhat, but it actually lowered. So that unemployment rate lowered even in spite of all the credit tightening and economic cooling. But we're expecting to see that change, and we're going to kind of at an inflection point. And the momentum typically is that once that starts to rise, you can kind of see that it does rise. And around that, you get, it's all kind of common sense that you might get a slight recession, slight pullback in the economy. But odds are that it will be of low magnitude and probably lesser duration than others that we've all experienced. This is very interesting. I point your attention here to the end here, and let me explain what all these colors and lines mean. The dark line is basically the labor supply. These are all the people that are actively of working age and entered into the workforce and are looking or are employed. So that's the actual supply of labor. Here, you can kind of see a disconnect from here to the top of this gray. That's the actual demand. So that's a shortage right there between what the economy can supply and what is demanded. So that will put upward pressure on wages. And that's obviously a big input into inflation. And strangely enough, there's another gap here. This, from the edge of this line to the top of the purple line represents those that are actually employed. So these above that, where the black line intersects, that's who could be employed, and this is who's deciding to work. So not only is there a gap between those that are wanting to work, there's also, in addition to the gap between who's there that can work and that the economies would like to work. So still working on that imbalance, but the data shows that there are less new jobs openings coming on, but there still are a lot of them in aggregate. So, but we expect to see that gap closing here in the short term to long term. This is just kind of interesting graph I showed here that shows that, it's kind of like real estate. The employment supply demand imbalance is imbalance among the country. You can see the lighter colors show that what this shows is the wage increases on average in percentage, an annualized rate. Lighter colors mean less of an increase. So there's, less wage inflation, and it's kind of held out to the coasts, if you will, to some degree. This is speaking generally, definitely in the West Coast, but a lot of that ties to the wage increases, the darker colored states, to some degree, where there's it's manufacturing, more union coverage, that type of thing, where there is more of a collective voice in terms of wage increases, and they're more sticky out that way. Out here, it has been less so. So kind of going on to like the topics of the day. One thing we've been hearing about is the bank crisis, and how that's going to affect things going forward. So I thought I'd go through a little case study on what happened with Silicon Valley Bank and where we're at now. So basically, the story goes that Silicon Valley Bank, they have depositors like anybody, but a lot of their depositors were entrepreneurs and companies. A lot of tech companies. I think Etsy was one of their depositors. And so they were well above the $250,000 guaranteed limit that the FDIC will cover. So how does a bank make money? They take deposits in, they pay a certain rate on that, and they lend it out at and buy various securities at a higher rate. So they get this, capture that spread. Well, on their books, they had many long dated bonds. And when you have a bond that's, let's say, 20 years, when interest rates go up or down, the bond's value is affected much more than a bond that is of shorter duration, just because there's more coupon payments that are going to be affected by that. You just have a longer payment stream. So they had all of these books that were held, or excuse me, all these bonds that were on their books that were what they call held to maturity. And held to maturity, you basically, when interest rates, let me step back for 1 second, sorry. When interest rates go up like they have been with the Fed's raising of rates, bond values decrease. I'll leave the long explanation out for that, but suffice to say, they have an inverse relationship. So when interest rates go up, bond values go down and vice versa. So they had these held to maturity bonds that basically they were held at what they bought them for essentially, and on their books. And when interest rates went up, they didn't have to take a loss on them. So they're unrealized losses on their books. Well, the particulars of Silicon Valley Bank was that its depositors, they're feeling the economy, the customers, depositors, if you will, the tech companies, they felt the crunch right off the bang, and they decided to take some of their money out of the bank. Well, they didn't have the capital on hand to meet those demands. So they actually had to go to the market, and they sold some of their losses at a loss of 1.8 billion. So that's a big loss. And that means the word got out. The tech community, they spoke among themselves. They, obviously it's not like where you have to physically walk into a bank or even call somebody. You do it on your cell phone these days, and you can take all your money out and it's transferred. So there was tweets going on. There was just kind of a virtual bank scare, if you will, and it happened all very quick. And to kind of stop any contagion from spreading to the banking system as large, the FDIC covered all losses. And they say it wasn't a taxpayer bailout because the FDIC funding comes from the bank, so their profits will get hurt. And I think in the end, the customer is always going to pay for that, for any type of those increases. It's like, when a lot of people drive badly, and the insurance company is going to increase rates across the board. So although taxpayers didn't directly pay for it, it was a kind of a government bailout in some form. So so that is what happened with Silicon Valley Bank. It seems to generally have been stemmed, and I think we're in a good space. Most of the bigger banks, non-regional banks, actually benefited for the most part from that, because people wanted the big large bank that there's no chance that it would go under, so they moved their deposits accordingly. And here you can kind of see that you can kind of bank returns this year have not been great, especially the regional banks down here. So they have lost call it 25% on the dollar overall stock value. Luckily, we are not invested in any of those regional banks. We do have some allocations to bigger banks that we feel were very, very adequately. They had great capital ratios, very safe, and were offered at a price that made them very good investments in our opinion. So moving on kind of to real estate, where we're at, we all know that interest rates are up. They've come down a little bit. They were at a high of 7%, 2 years ago. Approximately, they were, around 3%, even less But the bigger story, kind of macro story, is the affordability of the American dream, which would be a homeowner. The green line represents the share of income that rent represents, the average rent paid in this country. Blue line, same thing, share of income that represents a mortgage payment. And you can kind of see going along here that owning was actually, at least for just the mortgage payment itself, was more affordable, and was so, just very recently. But now the relationship has kind of gotten turned on its head, and it seems to be much cheaper to rent. So putting that kind of dream out of reach for many people, many young Americans, and there just happens to be a lack of supply and lack of cheap money to buy those houses. So it's a long-term question that at some point we will have to answer, especially in the Portland area. Again, kind of saying the same thing. This over time, this graph chart shows the percentage of the homes that are affordable in the largest 100 U.S. metropolitan areas, and you can just kind of see the trend is always down for the most part. Had a little bump up here, but I mean a real drop off just in the last year or so. But in 10 years, it's went from 50% to 21%. So a market decline. And I have many young nieces and nephews, and they are actively considering moving from the Portland area, because Portland is one of the metro areas that's rather expensive, as we all know. So real estate outlook in general. As I said, the recent highs are about 7%. Things are actually coming down, so that the accessibility of a home mortgage has become slightly better in 2023. The cost is up nationally, but it's so localized. So that's why you see a lot of people that are able. It really got started during COVID, work from home. That period where people were cut down their overhead and they could work remotely. Obviously, that's changed a little bit now as companies call back their workers. But in 75% of markets, it's actually down. The cost of homeownership is down, but overall in aggregate, it is definitely up. So as we went back to this third bullet point, kind of agrees with the wage increase, or at least inversely. The West and East Coast, the people want to live on the coast by the ocean. I'm not sure what exactly drive this. I think a lot of it is weather. You have climate change that is a factor for many people. We hear about that, and but the coast seems to be where people are moving, the coast in the southern regions. Interestingly, I was just in Chicago for that convention, and I had lived there for a number of years, and just my wife and I walking around, we just noticed how dead everything seemed, when it was just bustling, and no longer seemed to be the case. So, and just people are working from home, and there's just a lot of empty offices. Portland is at 27%. That's downtown Portland. The overall metro rate, I believe, is maybe half that, 13% vacancy rate. But they're estimating that maybe up to 1/5 of office space is going to have to be repurposed, and perhaps that could be to a greater good in terms of more living units. And the problem we touched back a few slides ago. So we'll have to see, but there's definitely pain to come in the office sector and retail, which has been a more drawn out general decline, but also pain there to be sure. Interestingly enough, I think it was in the Oregonian just last week, they had an article about the office, downtown Portland, trying to get off the mat after, kind of taking it on the chin during COVID in the last few years. And there seemed to be an exodus out to suburban office space. The office space actually out near our office on Cruz Way is kind of like was kind of the proxy for, the move from out of downtown. And although they kind of have the same vacancy rate, a little less than Portland, their rates have increased rather than decreased, because there's been for a variety of reasons, a move out of downtown Portland. So I'm rooting for Portland. I just hope they can turn it around. So we'll see. It's yet to be seen. But real estate tough place to be these days, I would say. Got to know what you're doing. Yeah, and again, this just kind of shows the general trend of vacancy rates. You kind of see, just 6 years ago, under 12, maybe 11 and a half. And, now we're up, 4 to 5% here nationally. So those are real numbers, billions of dollars we're talking about. So definitely a big shift, although I think it's kind of the work from home thing. I think that was when the economy's going very well, individual companies, let's say in the finance sector, banking sector, they will, allow that. But when times get a little tougher for certain sectors, they are definitely going to be the tech sector in particular, and banking sectors, they are calling people back on short notice, really. So that is happening. An outlook. We went through this, unprecedented time with COVID, trying to work from home and all that. As you can see here, 2023, the forecast is down in terms of units and dollar volume, home price appreciation, whereas, last year things generally went up. This data is from the end of last year, so the final numbers weren't in. So, they were saying about a 10% increase. This year, flat, and next year, possibly 5% in price appreciation. So for residential homes anyway. Third item that we've been hearing a lot about is the debt ceiling, and that's basically when there's a budget shortfall. We have more bills coming due than there's tax revenue collected to pay for that. So we've all seen this in the past. Congress, there's a big hullabaloo every time. Seems to be that every time eventually, common sense in one form or another, they realize they don't want to shut down the economy, which would be a very bad thing. They eventually do pass the legislation to fund the government's budget. But this graph here is pretty remarkable in that it shows the percentage of, the percentage of GDP, the percentage of the overall economy that the national debt represents. You can see that we, went over 100% for the first time during World War II to fund that, and eventually we saw the gold standard up until 1917. We got that down to a reasonable level. 1980s is where it really took off. Spending more than we had. Great Recession, to get out of that, there was a lot of just kind of emergency spending, and that ramped things up at a very steep rate. And then COVID-19, or excuse me, this was COVID-19, this is Great Recession down here, but same type of extreme acceleration of that debt versus GDP. You can kind of see we're towards the first quarter of 2020, we're approaching those World War II numbers. And I'm not sure on this number right now, I should look that up, but I know that the national debt is around 30 to 31 trillion. So it's pretty remarkable. And eventually something is going to have to give, and most likely it will be the prolonging of, the date when you can take Social Security, or a reduction in benefits. That isn't my expertise. That is definitely the ladies in opposite, or the advisors, so they would be the best resources on that. But it seems to be the most economists think that's where that if we do want to bring that down before you get a debt overhang issue, where basically the money or the investment that would go into other great uses in this country are going up to pay the interest. As the interest rises, that we'll have to pay on any new government debt. So you get a crowding out effect of good investment for paying off old treasury bills, if you will. And here, this just kind of shows the march up from that 1980, the national debt versus the debt ceiling. The line here is the debt ceiling. Here we're approaching it, and it gets raised. It gets raised every time as we go up. You can kind of see that we've in this century, it's risen up. The great financial crisis with that emergency spending, and then COVID. Here we are with another, almost vertical, acceleration, if you will. One thing to note is that red, blue. This is the on the chart here itself. This represents the party in the presidential suite in the White House, and you kind of see that it kind of goes up no matter who's in office. And down here is Congress, House and Senate, and you can kind of see it's the same thing. Even when, I'll leave everybody to interpret that as they wish, but you kind of see it's going up no matter who's holding power. So at some point, we're going to have to deal with this head on. I'm not sure when that will be. Finally, kind of in conclusion, where we're at, kind of summing things up. This is I haven't changed this much since the last time I did this in January, or it's February, excuse me, first week in February. But I just kept this bullet point the same, basically for the Fed and raising rates. We thought that there would be a one more 0.25% raise, and that did come to pass in May. In-house here, we believe that might be the end of it. It could be the end, and with the bank scare and all of that, with a little bit of trepidation on that front, that may cause for a pause. It might be the long-term pause. Diane and I have a bet. I'm slightly more of thinking that there might be one more hike before the year's end, but that's a coin flip. So if I had a bet, I'd probably agree with Diana that there's not going to be one. So we'll just have to see how that goes and where interest rates go from there. And hopefully we have this discussion all the time in-house that the Fed, with imperfect information, they've done a really admirable job of, at first kind of, not appreciating the inflation problem, the stickiness and the magnitude and what needed to be done to bring that down. But to their credit, they responded to the data and have raised things in a measured way, in a thoughtful way, and in regard to the economy and the average American. So there isn't that big drop off that's very, very, very painful. So hopefully that continues. That's our view that it will. In terms of market volatility, that first chart that I showed, the market last year was down close to 20%, and starting this year, it's up about 7.75%. Last Q4 of last year, it actually came up, about 7.5%, 7.6%. So, kind of goes back to that market timing argument. That there was a lot of volatility in between on a day-to-day basis. Oh my gosh, it's probably the second or third worst that I've seen in terms of daily swings, but overall up for the year to be sure. And we just think that choppiness is kind of slow down. It seems to have a little bit. We'll see, but we think that should be smoother in the second half of 2022. Going back to that chart about GDP growth, about where the Fed thinks it is. We're going with their prognostication in terms of 0.5% to 1%. Average is 3%, but that's by design because we've got to bring that inflation down. That is an absolute long-term killer to long-term viability of an economy. So they're doing what they need to do, and they're doing it rather well. So like I said, most likely just a soft landing recession, slight, what that means is, economic lack of below average growth. And that's kind of what we're seeing, or we're most likely going to see, I should say. And in terms of actual, deliverables, in terms of that number, the job gap, what I talked about before, that we think that will come to decrease in terms of the imbalance, with bringing wage growth down as there's less openings as that kind of matches what the able-bodied and willing workers are seeking out. And of course, that is a huge input into inflation. We think that's coming down, and it definitely is. And we hope that the Fed's prognostication of 3.75% by the end of the year is on the money. And that unemployment rate, although it always sounds negative to have that come up, but that's we want to get into that healthy balance of keeping kind of all the gears and the lubrication of the national economy going. So with that concludes my formal remarks.